Why would a modern democracy like the United States bring back something called the War Department? This name hasn't been used since World War II. For over 70 years, America had the Department of Defense, a name meant to sound defensive, not aggressive. But President Trump just revived the term War Department. This is ascend your mind, decode the markets, protect your future. This isn't just about military rebranding. It's about signaling a new global economic order, a shift that could reshape your money, your job, and your future investments. Stay until the end because I'll break down which assets, from stocks to gold to Bitcoin, could surge in this new war economy. To understand the impact, we need to look back. The War Department was once the most powerful arm of the U.S. government, directing America's efforts in World War I and II. In 1947, it was renamed the Department of Defense to soften the image. America was defending freedom, not waging wars. Reviving the term War Department in 2025 is symbolic. It tells the world America is no longer pretending. We are officially in a state of economic and geopolitical confrontation. So why did Trump do this? Politically, it rallies Americans around the idea that the nation is in a wartime economy. Once people believe the country is at war, they accept massive government spending. This gives Trump political cover for trillions in new defense budgets. Economically, defense spending is stimulus. The U.S. spent $886 billion on defense in 2024, more than the next 10 countries combined. Every $1 billion in defense creates roughly 7,000 to 10,000 jobs in aerospace, cybersecurity, and manufacturing. Instead of handing out stimulus checks, which cause consumer inflation, funneling QE into defense creates jobs without flooding households with cash. Geopolitically, it sends a clear warning to China, Russia, and Iran that the U.S. is preparing for a long confrontation, and it pressures NATO allies and Europe to raise their military spending as well. But there's a hidden agenda. In times of war or crisis, global capital rushes into the U.S. dollar in treasuries as safe havens. Even with $35 trillion in U.S. national debt in 2025, investors still buy treasuries when instability rises. Normally, money printing weakens a currency. But if QE is tied to defense and war spending, the opposite can happen. The dollar strengthens because the world sees America as the ultimate safe harbor, while emerging markets suffer as their currencies collapse under dollar pressure. This is the paradox. America prints, America spends, but the world pays the bill. So who wins and who loses? The winners are clear. U.S. defense contractors like Lockheed Martin, Northrop Grumman, Raytheon, and General Dynamics. Tech and AI firms serving the Pentagon like NVIDIA, AMD, and Palantir. Cybersecurity leaders like CrowdStrike and Palo Alto Networks. Aerospace and space warfare companies like Boeing and AeroVironment. The losers are just as clear. American consumers who will face higher prices for imports, food, and energy due to tariffs and instability. Emerging markets which will face capital flight, currency devaluation, and soaring dollar-denominated debt. And Europe, which will be forced into higher military budgets while still struggling with energy dependence and debt crises. Now let's turn to gold and Bitcoin. Gold historically rises during geopolitical crises. During the Iraq War in 2003, gold climbed 13%. During the Ukraine War in 2022, it gained 7%. A war economy means a strong dollar, but the war premium still supports gold. Expect stable upward moves, but not explosive. Bitcoin tells a different story. In 2020 and 2021, QE checks pumped into households fueled Bitcoin's surge from $7,000 to $69,000. War QE won't give free money to households, but it still expands liquidity. And the narrative is powerful. Bitcoin is digital gold against endless money printing. Expect Bitcoin to outperform gold percentage-wise, but not at COVID stimulus levels. Let's ground this with some numbers. U.S. national debt is $35 trillion. Annual interest payments are $900 billion, larger than the defense budget of any other nation. The Pentagon's 2024 budget was $886 billion. And Trump signals it could cross $1 trillion annually by 2026. Defense stocks are already outperforming. Lockheed Martin up 14% year-to-date, Northrop 11%, NVIDIA 35%. That's the big picture. But if we dig deeper, the picture becomes even clearer because the label War Department does more than change stationery. It changes how money flows. In a war economy, Congress authorizes multi-year procurement, the Treasury issues more bonds, and the central bank quietly makes sure the plumbing never clogs. QE tied to defense is not a helicopter drop, it is a pipeline. Dollars move from bond buyers to the Treasury, from the Treasury to prime contractors, then ripple out to hundreds of subcontractors that make engines, sensors, composites, software, and munitions. That pipeline leaks far less into day-to-day household consumption than stimulus checks did. It lifts payrolls in specific zip codes, not at every cash register in America. That's why CPI pressure can stay contained even as nominal spending rises. There is also a legal and political dimension. An executive order can signal a secondary title or rebranding, but statutes still govern the department's official name and authorities. In practice, markets don't trade on the letterhead, they trade on the budgets. If the outlays rise and the order book fattens, multiples expand in the names that matter. The message to investors is simple: ignore the optics, follow the appropriations, consider the arithmetic. The federal deficit for 2025 is projected around $1.9 trillion. Net interest alone is closing in on $1 trillion. If long rates stay elevated, refinancing the debt gets painful. That is why you should expect a soft pivot in the balance sheet, a pause or slowdown in quantitative tightening, and, if stress appears in funding markets, a willingness to stabilize long-duration yields. The combination of higher top-line defense spending and gentler financial conditions is precisely the recipe that lifts defense, dual-use technology, and mission-critical cybersecurity ahead of the broader market. Europe's reaction is part of this story. When Washington signals war footing, Brussels hears spend more. NATO allies have already converged on 2% of GDP for defense, with several pushing higher. That rearmament wave creates a second demand pool for U.S. suppliers, joint ventures, and licensed production. In plain English, American defense IP earns twice, once at home, and again when allies retool. For investors, that means the revenue runway is not just federal, but transatlantic. Now the risks. War budgets are not straight lines. Supply chains can snarl, from solid rocket motors to advanced semiconductors. Skilled labor is scarce in precision machining and avionics. Margins can compress when the Pentagon insists on fixed-price contracts. Procurement cycles can slip a year. And a ceasefire or de-escalation headline can knock 10% off war stocks in a week. That is why position sizing matters. You don't buy the theme blindly. You ladder entries, you diversify across primes, subsystems, and software, and you keep dry powder for drawdowns. Gold requires its own playbook. Think in regimes. If the 10-year Treasury yield falls because the Fed leans easier while geopolitical heat stays high, gold tends to grind higher as real yields ease. If inflation expectations break above 3% while growth cools, gold can accelerate. If the dollar rips on a flight to quality and real yields rise, gold may stall, yet still hold a war premium. For a household portfolio, the job of gold is not to make you rich. It is to keep you solvent when correlations snap. Bitcoin is different. Its drivers are liquidity, narrative, and access. Liquidity improves when central banks slow QT or backstop markets. The narrative strengthens each time governments admit they must spend more and tax later. Access improves when regulated products pull in retirement money. If those three line up while the war economy narrative dominates headlines, Bitcoin can outrun gold on a percentage basis. But volatility cuts both ways. A tougher regulatory stance, an exchange failure, or a sharp risk-off in tech can halve prices before you can react. That is why a rules-based approach, small allocation, and long horizon matter more than headlines. Here is the practical takeaway. If you are an everyday American hearing the words War Department again, you are not powerless. Start with a core satellite mindset. Keep your core diversified, then build satellites that reflect the new regime. A small basket of defense and dual-use tech names for growth. A steady allocation to gold for stability. A measured sleeve of Bitcoin for asymmetric upside. Rebalance on a schedule, not on emotion. Add on weakness when the thesis is intact, not on euphoria when social media is loudest. Also, watch the 3 dials that truly move this machine. First, watch appropriations and supplemental bills. That is real money. Second, watch the central bank balance sheet. That is real liquidity. Third, watch the dollar index and long bond yields. That is the price of safety for the world. When budgets rise, the balance sheet softens, and the dollar stays firm. You are in the heart of the war economy playbook. When any one of those 3 turns violently, tighten risk and protect your gains. Finally, do not confuse clarity with certainty. The United States can both strengthen the dollar and increase spending because the world still buys the story of safety. That privilege will not last forever, but it is powerful now. Your job is not to predict the final chapter. It is to read the current page and position accordingly. If you understand why the name War Department is back, you will understand why capital is moving the way it is, and you will know how to move with it. This is Ascend Your Mind. Decode the markets. Protect your future. In the next episode, I will lay out several specific stocks at the center of this shift and the exact catalysts that could unlock their next leg higher. I will also show you a simple portfolio framework that balances war economy upside with real-world downside protection. Subscribe, stay sharp, and let's turn uncertainty into an edge.